If you woke up this week, checked gold or silver prices, and felt that sudden pause in your chest, that moment where you think something bigger is happening, you're not imagining it. Because what we're seeing right now in the precious metals market is not normal volatility. It's a pressure buildup that has been quietly forming for months and is now finally breaking into the open, driven by fear, speculation, central bank signals, and a world that feels one headline away from another shock. And the reason this matters to you, whether you actively trade or not, is because gold and silver don't move like this unless the financial system itself is under stress. And today I want to walk you through what's really happening, not the surface level uncertainty around interest rates, around government debt, around geopolitical tensions, and around whether central banks still have full control of the system they created. And in the United States especially, investors are stuck in a psychological tug of war. On one side, there's the belief that higher rates should push gold down. And on the other side, there's the fear that those same higher rates are exposing cracks in the economy that paper assets can't hide forever. And this contradiction is exactly why price action has become so violent, because traders are no longer confident. They're reactive, jumping in and out on every Fed comment, every inflation print, every geopolitical headline, and silver, which has always been more emotional than gold, is amplifying that fear and excitement at the same time, moving like an industrial metal one moment and a crisis hedge the next. And here's where updated forecasts come into play, because many US-based analysts are quietly revising their outlooks, not necessarily calling for straight-up price explosions, but acknowledging that downside is becoming more limited while upside risk is expanding, especially if the Federal Reserve is forced into a policy shift sooner than expected. And that's the key word, forced, because the Fed doesn't operate in a vacuum. It reacts to economic stress, market instability, and political pressure. And when you combine massive government debt, persistent inflation pressure, and slowing growth signals, gold and silver start acting less like commodities and more like insurance policies. And this is why long-term investors are stepping in on dips, while short-term traders are creating chaos on the charts. And I want you to pause here and think about this. Ask yourself in the comments, do you see gold and silver as short-term trading vehicles, or as long-term protection against a system that feels increasingly fragile? Drop your answer below, because I read those comments and they shape what we cover next here on AI Concepts. And what makes this moment even more fascinating is that sentiment is split almost perfectly. Half the market believes metals are topping out, and the other half believes we're only in the early stages of a larger repricing. And historically, those moments of extreme disagreement are where the biggest moves are born, because once the market chooses a direction, it tends to move fast and without mercy. And this is why volatility itself has become the signal, not the noise. When gold swings hundreds of dollars in a short period, or silver jumps and drops in rapid waves, it's telling you that large players are repositioning, hedging, and preparing for something they can't fully predict yet. And in the US financial ecosystem, where retirement accounts, ETFs, and institutional funds are deeply intertwined, that repositioning has ripple effects far beyond metals alone. It affects stocks, bonds, currencies, and even consumer confidence. And here's something most people miss. Central banks around the world, including those aligned with and opposed to the US, are still accumulating gold quietly, even during pullbacks. And they don't do that for short-term gains. They do it for strategic reasons, for trust, stability, and leverage in a changing global order. And silver, while not held the same way, is benefiting from both monetary fear and industrial demand tied to technology, energy, and AI infrastructure, which creates a unique tension that can explode in either direction. And this is why forecasts today are less about exact price targets and more about scenarios. Scenarios where rates stay higher for longer. Scenarios where the Fed pivots. Scenarios where geopolitical risks escalate. And in most of those scenarios, gold and silver remain relevant, volatile, and impossible to ignore. And if this breakdown helped you see the bigger picture, do me a favor and share this video with someone who keeps asking why metals are acting so crazy right now, because these conversations matter, especially when misinformation spreads faster than facts. And as we move forward, the smartest investors won't be the ones predicting exact highs or lows. They'll be the ones understanding why the market behaves the way it does under pressure. And that's exactly what we focus on here at AI Concepts, connecting data, psychology, and real-world EVA. TIAs into one clear narrative, and the final question I want to leave you with is this: when the next major move happens in gold and silver, will you be reacting in panic or responding with understanding? Because the market doesn't reward attention, it rewards preparation. And if you want to stay ahead of what comes next, you already know what to do.